Hello and welcome. My name is Bart Kendall. I'm the Director of Wealth Management here at GlobalEye. Today, I'm going to be talking about the 5 key questions you need to be asking of your UK pension. To quote a prominent economist at the Bank of England, he stated he considers himself moderately financially literate, however confesses to not making the remotest sense of pensions. And I think a lot of people feel in this way. So it's the intention of this video to give you some greater clarity in what is a very broad and often misunderstood area, to give you the 5 key questions so you can go to your pension scheme, get the right information back to undertake an effective pension analysis. So there's 5 key questions that I've said. Let's dive straight into it. Question number 1, is my UK pension scheme financially stable? When we talk about financial stability, you've seen the headlines, UK final salary pension scheme deficits at record highs. PricewaterhouseCoopers was quoted as stating that the total value of UK final salary pension deficit at the end of March 2020 was £290 billion. There's 4 companies in the FTSE 100 whose pension deficit, if it was a standalone company, would also make the FTSE 100. There's 5 companies in the FTSE 100 pension schemes whose total pension liability is greater than the market value of the company itself. So pension deficits are a very consistent trend across UK final salary pension schemes. So what are they and when should you be concerned? Well, a pension deficit is when the total liabilities of the final salary pension scheme, think of it as the payment promises to its members, exceed the assets they hold or the money they've got to pay for those pension promises. That's when a deficit occurs. When a firm puts a value on the aggregate value on the pension promises it holds to its members, it estimates future payouts based on the prevailing interest rate at that time. So when interest rates fall, or the lower the interest rates go, the higher the pension liabilities increase accordingly, because there's less money, of course, to pay for those pension promises, and more money needs to be found by the corporate, the sponsor, to plug the gap. So when should you be concerned? You should be concerned, really, a combination of 2 things. One, a significant pension deficit coupled with an uncertain outlook for the corporate, the sponsor, because where's the money going to come from if the sponsor is under significant financial pressure? You need your pension distributions for the next 30 years, 40 years. You need to know your pension scheme, and the corporate sponsoring the pension scheme can absorb the market shocks, the cyclical market shocks, which inevitably are happening now. They happened previously, and they will continue to happen in the future. Very, very important. There are a number of schemes, not just in the FTSE 100, but a number of pension schemes, very well funded, posting healthy surpluses. So you need to just understand, where does your scheme fit? That's very important. Is my UK pension scheme financially stable? That is question number 1. Question number 2, what is lifetime allowance, and what is my lifetime allowance protection? Lifetime allowance is the total value you can hold in UK pensions without incurring an additional charge on the excess at the time you take benefits, known as a benefit crystallization event. Started in 2006, went up to 1.8 million in 2011, so you could have 1.8 million pounds worth of pensions without incurring additional charge when you take benefits. How do you calculate the value of your pensions for lifetime allowance? Well, it's 2 things. One, if you've got a money purchase scheme, a defined contribution scheme, a fund, it's the value of the fund, the pension fund, at that time. If it's a pension promise, a final salary pension scheme, it's 20 times the pension promise. So you add it all up, and whatever that figure is, that is the total value for lifetime allowance assessment that you hold in UK pensions. In the tax year, this tax year, 2020 to 2021, it's £1,073,000. So if you want to take benefits, and you can take benefits over 55 this year, and that's something that you would like to do, then based on your current lifetime allowance, if you had an amount in excess of 1,073,000 and you wanted to draw down, then the excess, if you took as income, would be charged at 25% plus marginal rate income tax. If you took it as a lump sum, the excess would be charged as 55%. It's a significant charge. It can have a material impact downwards on your pension income net position. There are ways of potentially increasing your lifetime allowance protection to 1.25 million. You have to fulfill certain criteria. You have to qualify for it. So suffice to say that unless you understand lifetime allowance or you haven't looked at it before, I strongly advise that you do so. If you have a pension pot, a final salary pension promise of £53,000 a year, you're on the cusp of lifetime allowance. If you've got a pension fund of £1 million, you're on the cusp of lifetime allowance. Very, very important to look at if that applies to you, because as I said, any amount on the excess do incur a potential significant charge on distribution at the time you take benefits. Question number 3, how does my pension work? I don't mean what's your normal retirement date, what's your pension promise, what are you expecting? Most people know that. What I'm really talking about is understanding your pension to the extent that you can conceive any particular scenario in your life, both pre and post retirement, and understand exactly how your pension will respond in that situation. That is truly understanding your pension. So for example, if you would like to retire at 57, well, are you able to take early retirement? And if so, would you be actuarially reduced on your pension distribution because they're paying out longer? Most likely, but do you know that's an option? Having a pension commencement lump sum, is that important to you? If you were to die before retirement, what does your spouse get? Is there a children's pension? And if so, what it is? And I'll put the same questions post-retirement. And what's the inflation increase on your final salary pension on an annual basis? When you have all this information, and it's not exhaustive, I've just covered the main aspects, you can then map out reasonably how you'd like to live your life, when you need money, the frequency to which you need money, how, when you're estate planning, how much you'd like to be passing on to your family, your loved ones. And you can then map out how your pension, as it stands right now, will respond. All this information, clear language in the scheme booklet, contact the scheme trustee, very, very clear language. That will give you all the information you require. And at that point, you're then in a position to assess your pension as to whether it complements and how much it complements the life you would like to lead. So that's very, very important, understanding your pension. As I said, all this information is in the scheme booklet. You can get it from a transfer statement. It gives you all that information, 3-page, 4-page document alongside the scheme booklet, and you'll have all the answers there. Very important to understand every single nuance of your UK pension. Question number 4, are the tax planning opportunities with my UK pension? Just because you have a UK pension doesn't mean you don't have a potential ability to tax plan. If you're an expatriate, if you've been away from the UK for a certain number of consecutive tax years, then where you are now tax resident, if they now have a double taxation treaty with the UK, depending on the language of that under the pension section, depending on your age, when you're taking distribution, all of this, when you bring it all together, means that potentially, for a few of you listening, you may have the ability to claim double taxation treaty relief on your pension distribution. Now, I'm not a tax advisor, we are not a tax advisory, but we work with some of the largest tax consultancies on a worldwide basis who will give you cross-border pension tax opinion as it relates to your own circumstance. I know from experience that people have the ability in certain parts of the world to benefit from double taxation treaty relief. And if you're not aware of it, well, tax as an overall assessment of your pension analysis is a very, very key area. And this particular section of the analysis is critical in you understanding what you may be receiving from a pension distribution on a net position where you are looking to live. Very, very important to understand double taxation treaties, if applicable, as it relates to you. And you should really look into more detail in this area. Very, very important. Lastly, what is the transfer value of my UK pension? Firstly, why should you consider a transfer value? It's your statutory right as an individual to request a transfer value once a year. I always advise that you request a transfer value for a final salary pension scheme at least once a year, because you really want to monetize the assets that you hold, just like you monetize all the other assets you hold. The property values fluctuate, but you still want to know what that value is, whatever the values of any other assets you hold. For some of you working for many years in an organization as a final salary pension promise, more than likely to be your largest asset. It's also just good, solid financial planning to understand what it is worth in accordance with its pension promise or in relation to its pension promise. Now, when you request a transfer value, you need to understand that your pension promise actually has no value. Okay, a final salary pension scheme is very simply just a promise from the pension scheme to pay you a fixed salary in retirement, increasing in line with inflation for the rest of your life. But when you request a transfer value, the scheme actually needs to monetize that promise into a value. And they do so using long-term gilt yields, because they can assume that, let's say back in 2007 on the far left of this chart, you would have received 5% a year just over on your money. However, they can only assume now in April 2020 you'll receive 0.48. So much more needs to be provided upfront now by way of a transfer value, assuming less growth to normal retirement date, to an amount that may broadly match what you could have expected from your current scheme. So the lower, as you can see, the gilt yield broadly and in isolation, the higher the transfer value. Gilt yields are very, very low at this present point. A leading accountancy firm which publishes a transfer value index now has been quoted as saying for every £10,000 worth of pension promise, you can expect on average £250,000 worth of transfer value. That's a multiple of 25 times on average the final salary promise in transfer values for the same benefit. It of course fluctuates. Look at the gilt rate chart, you can see the significant fluctuations there, which means that broadly and in isolation, as I've said, transfer values fluctuate accordingly. But it's always good to assess the trend. It's always good to know what is the value versus the promise. That gives you a very rounded view, not just of your overall pension value, but also of the pension itself and what you would like to do with that pension. So there's been 5 areas I've covered today. Pension health, UK financial pension health of your UK pension scheme, how your pension works in detail. If you have larger pots of money, have you considered lifetime allowance? Have you done the calculation for what you hold for lifetime allowance purposes and estimated the value of your current pensions right now for lifetime allowance to better understand, therefore, if you potentially will be incurring an excess charge on lifetime allowance for those amounts in excess of your current lifetime allowance protection. Remember, 20 times the final salary promise or the value of the fund or both all put together gives you that value for lifetime allowance purposes. There may be tax planning opportunities you have with your pension as expatriate. If you're not aware of it, I strongly advise that you explore to see what kind of tax planning opportunities you may have. And lastly, once a year, just have a look at the transfer value, look at the variance, look at what you're being offered to leave the scheme. Not that you want to leave the scheme, but just have a look at what you're being offered to leave the scheme for the same benefit. It's interesting to know the fluctuations. Bring it all together. And when you bring all that together, you're then in a position to say, right, this is what I've got. This is how it will respond in every conceivable circumstance. I'm now satisfied that I know everything I want to know about my current UK pension. If you have any questions on this, please let me know. If you have any areas of uncertainty, again, please get in contact, and thank you for listening.